So take a look at the S&P on the daily chart, and there are some interesting similarities here that I want to point out and also explain why it is not the case that we are in a very similar move as you see here on the left side of the chart. This was all of the run-up in 2010 to the beginning of 2011 before we kind of went sideways for the longest time, formed this head and shoulders topping pattern. Before all of that, though, you can see here the basing pattern is a inverse head and shoulders bottoming pattern, and from that point we had a huge up leg, and you could even classify this move as a bearish rising wedge. Hence the break of the trend line. We had a back test of it and then a lower low. We had a sell-off. Now this pattern morphed into a much larger and different pattern. It didn't collapse on us. It formed actually a left shoulder that you see here. This was the head, and then this became the right shoulder of this entire topping pattern. The point is, we went sideways for the longest time up here, just like we did here, and allowed for a much larger move to the upside as well as to the downside after the top was complete. So when we look at the pattern that we're involved with here, some people think that this part here is the left shoulder, this being the head, and this being the right shoulder. The problem with that scenario is the neckline of the pattern is such at an unsustainable angle that prices at this point would have to go parabolic just to break the neckline of the pattern. And usually what you see is when the neckline of the pattern is broken, it's on strong volume and there's much more follow through. Now I think that's an improper evaluation of that whole basing pattern. This is what's known as a double bottom, and in LA wave terms this can even be called a bear flat. It's where this second low breaches this previous low and it quickly reverses on you, and you see this powerful momentum back to the upside. And I think it was this day, the day of the reversal, the Dow was up like 300 points at the close, but it reversed with 45 minutes before the close and up 400 points. So it was down about 100 and came back, closing above 300 points. That was at that point, of course, you would have known to close your short positions. But the point is, this double bottoming pattern, if you draw the length between the two, the base equals the height of the move. And we got that at this point. Now we have since then pulled back, and then we've rallied back to new highs from this overall pattern, and we've even exceeded this May high. Now with that said, I want to go a step further and show you this entire leg up, and I want to show you why we're near its completion. This is what's known as a measured move. You have the first rally up, the retracement, then you have the next leg up. We're at that point there, and we're even slightly above it. Now it's not exact, but it comes in the area that you should be looking for, and that is the distance between the first rally from the retracement to the next point. And so we're right here at 1404 that you can see, and you know, it's very well possible that prices may want to go slightly higher, but in my opinion we're at a point where if prices go slightly higher, that's okay, but the advance is limited, and to me this almost looks like it could be a left shoulder developing, where this would be the head of the pattern, and we may get a sideways move and form a right shoulder before we ultimately give way. Now anytime you look back and you see a multi-month rally like this one, especially just straight up, and you see very little overlapping all the way to the upside, and now we've got a breakout, you see that after a while we either go sideways or we quickly give back, and the type of sell-off that takes place is usually violent, usually quick, and it gets us to oversold conditions that ultimately find us a new bottom. So now that we've given a good look to the daily time frame, I want to point out exactly what we're looking at on the weekly time frame, and this brings us back to the 07-08 time period. And you know, this right here can be classified as a double top, with this slightly higher than this previous peak. And we again went sideways for the longest time, so there's a lot of excess supply in this area, and believe me, there are a lot of people waiting for when prices get back up to these levels just to break even. So there's going to be resistance, a lot of resistance all in this area, and we're just now coming in at the first minor high, and that peak, as you can see here, was 1440. Now, it doesn't mean that we're going to go to 1440. We're going to see how prices can react in the days to come, because we're already in this level, and I don't see any selling pressure yet on the weekly chart. So with that said, I want to analyze this side of the chart. I want to show what we can make of the previous support and resistance levels from the 07-08 time period. So we have here a minor support level from where prices retraced to this point, and then they went to new highs again. They sold off, retraced. They sort of retraced to the resistance point, because after it broke, it came back up and it retraced that same level. And you could even say that this was an intra-week low, and it came down to test this previous support level. Now, once this support level was decisively broken, we rallied back up to the same support level, and now it acted as resistance. It's really not exactly there at that same support level, but it's the area that we're looking for, because it's coming in at this point and at this point. And then following that, we had lower lows until we ultimately crashed. But where we are now, considering how overbought we are on the daily time frame, you throw in the fact that it's a bearish rising wedge, momentum is diverging, you've got the internals diverging, and we're also coming in at a resistance point. It's likely that, given the move, and with the whole idea that this advance is limited, it makes sense, because we should at least take profits here at this point, or we may even get a reversal, depending on what takes place. Okay, now I mention the internals often, and I want to explain to you just several that I follow. And one is that I follow the stocks above their 50-day moving average. And when you see here, and I'm going to try and show this the best that I can to you, I have the S&P daily chart shown, and we have obviously higher highs being made, but again we're seeing lower highs on the stocks above their 50-day moving average. Now, what does that tell you? That tells you that there are now less stocks out there from this previous high that are above their 50-day moving average, suggesting that when investors are buying into the market, they are becoming more and more selective into the stocks that they're choosing. You're not seeing this broad-based participation. And believe me, that's what's needed for a sustainable rally. And usually you get it, these kind of divergences that set up on the internals that give you a heads up, they give you a non-confirming but warning signal that the market is showing weakness. Now here's another one, and this is the, obviously you can see here, the 52-week highs made on the New York Composite. There are less stocks out there making 52-week new highs, and yet the market averages are still going higher. So it's telling you again that there's divergences forming, and that the individual stocks within the averages are not doing what you see of the overall market average. So this is telling you what is going on in terms of the anatomy of the particular index, and yet you're seeing the overall averages moving higher. Now, a lot of that has to do with how certain stocks are weighted more than others, but again, less participation is going bearish, and it gives non-confirming signals with the divergences that a top is near. Okay, and those are just a few types of internals that I follow. I follow many others, but just for this video I wanted to show you several. Okay, so here's the Russell, and the Russell's having a hard time getting above its previous highs. And that right here, you can see, I mean, it almost looks like we're going to have a directional move one way or the other, but again, if we have a move to the upside, we'd need to see a break above the previous high, and this is the intraday high that was made back on the February 3rd at 833.02. We would need to see a large impulse bar that would break above those highs. Now, we have basically gone sideways for weeks here, and then we dipped, we came back up, and again we're coming right at the same resistance level. I mean, there's clearly a lot of resistance in this area, but eventually we will get a decisive move. Now, at first I thought this was a 1, 2, 3 reversal, and it still may play out, but usually prices don't remain up back in this larger consolidation zone or even a distribution pattern. So we'll have to see exactly. Again, these kinds of patterns are tricky because you don't know which way they're going to break to. They're either going to break to the upside or downside. There's a 50-50 chance, and even if you follow volume, if it's declining, it still doesn't tell you what's coming ahead. But I think the main picture, again, to point out that we're having a hard time getting back above the previous highs of the, well, in this case, May the 2nd, and yet the market averages, like in the S&P and the Dow, are well above those. And so it just tells you that the Russell's not confirming the move, and again, the transports as well. They're, right around this same area compared to their previous highs. So the thesis here is that you're not getting confirming signals in almost every aspect of technical analysis. I mean, you're seeing that the market averages are not confirming the moves that you see in the S&P and the Dow, because you have the Russell, the transports, the New York Composite not making new highs. You're seeing in all of the just swing indicators and momentum indicators divergences setting up. You're seeing the internals setting up. Along with that, you have a bearish rising wedge setting up on the S&P, which is extremely bearish, and it's not indicative of a new bull up leg in a larger bull market. So you throw that in with a combination of those bearish implications, and it tells you that we're likely to get a sell-off of some kind. Now, whether we take out those October lows remains to be seen. I personally don't think that we will, because we have generated enough strength from this multi-month rally that it's going to take basically an outright crash move to sell off and break those lows. It's very well still possible. It still may be in the cards, but we have gone straight up for months now, and the fact that we're starting to see the dollar move higher with the market, it's telling you that money is coming from Europe and money is coming from other sources, and still there's a lot of cash on the sidelines that can still push this market higher. You throw that in with the fact that Bernanke's printing money behind the scenes, so there's this every effort on really everyone's part as a catalyst to just manipulate this market higher. Okay, and the last thing I want to talk about is the dollar, and I have two trend lines here, and this is the intermediate trend line, and it seems to be holding up. You can see the support level at which each time prices react off of the trend line. So you've got this point, as well as this point drawn. Now, from this shorter term trend line, it does appear that we have slightly breached that trend line, but we are coming in at a previous resistance point, and it should act as support. Okay, so with that said, coming off of this divergence is likely to set up the dollar to go higher to form another divergence before it can reverse. Now, you see these large impulse bars, the way the candlesticks have moved to the upside, suggesting that a lot of strength is going into this move. Now, we've had to come out of some choppy, type of price action, but we managed to get above the previous high. So, it's very well possible that the dollar may pull back a little more here, and that could allow for just kind of a sideways action before they resume higher. But I think for the short term, yeah, I see weakness, but I think it's possible that we're just retracing for maybe either a bull flag or a sideways type of action before it goes higher. So again, we're coming in at this now a resistance point, so the first test is obviously going to have prices react strongly off of them, and they'll kind of build up enough steam before they go back up and then try and break those highs. So anyways, I hope you enjoyed the video, and have a good weekend.